And Chris, you in your home office you're in Northern Virginia, right?
I am. I'm in my my bunker, my fabricated office in my basement.
The secret bunker location where they kept Dick Cheney. Is
Yeah,
that?
exactly.
Yeah.
I can poke him. He's right over there.
Where are you? You're in Northern Virginia?
Yeah, I'm in wonderful Fairfax County.
Do you own a horse?
I'm sorry?
Do you
No.
own a horse?
No. Why would you ask?
Northern Virginia, isn't that horse country?
Well, apart from the 3 million people that live here, there are probably 100,000 that have horses, but you know, they get run over on by traffic often. But interesting you should ask. I do kind of live in this little enclave. Most of the horsey country is out, you know, west of here, Middleburg and all those, you know, multi-millionaires. But I live in Oakton, which has a number of we don't have sewer. So everybody's got like 1 to 3 acres, and there's actually some horses where I live, but no horses elsewhere in Northern Virginia. Just a lot of highways and office buildings.
How's the property value, Northern Virginia? I have some family there, like the famous like condos starting at 1.1 million. One of the signs you see in Northern Virginia a lot.
Yeah.
Is it big crazy still?
It's crazy. You know, it was super expensive before the big run up. We probably didn't see near as much of appreciation. We saw a decent amount, but you know, we're kind of just expensive.
Hey, Chris. Rich is just trying to find out how well he's doing versus his family members. Yeah, just trying to gauge the real estate balance sheet.
Yeah, so you always can see right through my thinly veiled motivations. Happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with a special 12 days of TMC edition of the Rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. And as always, pleased to be joined my esteemed colleague and co-host, Rob Krisman. Rob, great to see you. Where the hell are you and what's the hat?
Well, the hat was given to me by the Eastern Tennessee chapter of the Tennessee Mortgage Bankers Association when I went to Johnson City to do some speaking. I'll show you where I am, Rich. You try to figure out where I am. All right.
You
ready?
Look cold. You're normally not in cold locations. Is that snow? Wow. Oh my Lord. Wow. Are you in the Midwest? Are you in Chicago? You're probably in Chicago. Oh, is that mountains in the background? That's not Chicago.
Next Friday I will be in Chicago for several days. This is Lake Tahoe.
I was going to guess you're in Lake Tahoe.
Tahoe, there you go.
Lake Tahoe, and it's
Fredo
bitterly
Corleone.
cold.
Fredo, I saw Fredo Corleone back there. Yeah.
Yes, and but this is keeping me warm, Rich. I knew that you would okay with me adding this to my on assignments expense account. It's called a Wet Woody, and I'm at Garwood's Restaurant on the North Shore of Lake Tahoe. So
we've gotten a lot of feedback from listeners that you're much more entertaining drunk. So yeah, drink up. We have very loose rules here on the Rundown.
Yeah.
So you can keep them coming, bartender. Many amazing locations you showed up from on the show this year randomly. Never know quite where Rob's going to show up from. But
I really got to submit my expense account before year end.
Yeah, I remember the random bar in Alaska. That was maybe my favorite with the bartender in the background. Yeah, that was
I can't get far away from that alcohol theme. But enough about me. Let's talk about MGIC.
And our co-host this week, a good longtime friend of the network, MGIC's vice president of the sales, their national credit unions manager. He also manages the long and excellent partnership between TMC and MGIC. So a guy that's heavily woven into our network. Always enjoy getting his perspective on the depository side of the business and just the business in general. Chris Perry. Chris, great to see you.
Great to see you all. Thank you, Rich and Rob. Just a little quick something on MGIC. Yeah, we're really excited to be celebrating our 65th year, 6 decades of helping over 13 million homeowners buy homes. And, you know, I think a lot of people say in MI that it's all about pricing these days. You know, we've achieved a #1 market share status for the last 2 years. So obviously we've got great pricing, but, you know, MGIC, we really take the approach that it's more what we can do for you to help you do mortgages and those many things that we do to earn your business. So that's really our approach. And we're excited to be partners with TMC and to be able to participate today.
You get one of these years like this, and it reminds you like the industry standards that like MGIC, right? Like don't get me wrong, a lot of great new companies, many partners at TMC that are built to last and are outstanding companies. But you know, there's something to be said about a company that you just, you know, is doing things the right way and has been there, will be there. And that, more than any company, honestly, in this industry, MGIC is who I think of when I hear that. And it's testament to you guys. And #1 market share, I saw that a couple of years ago when that happened. And that's also a testament to you guys, because MGIC, like, at least in my history of just buying MI and selling MI, they were never one. They were always like 2 or 3, always around the top. But now, you know, I think we've seen kind of a flight to quality these last couple of years.
It's slim though. I mean, you know, what pricing is extremely competitive. And since I've worked here, we've always kind of hovered around that 1 or 2 in most states. But yeah, it's, you know, pricing, mortgage insurance pricing is lower than it's ever been in the 30 years I've been in the business for the better loans right now. So it's a good value.
You know, all the negative headlines and all the negative crap to talk about this year. That's something you don't hear, right? And that is true. MI premiums are the lowest they've ever been. That'll be a big catalyst to the, you know, what we see on the other side of this when things normalize. So
helping with affordability.
Yeah, absolutely. So excited to get your perspective on all that good stuff as we get into it. So Rob, you know, these inflation numbers continue to dominate the open of this show because it's our entire industry is kind of hinging on it. We're not on the sidelines, but you know, it's it is obviously hinging on the interest rate climate. And we're in this spot right now where for rates to get to a point that will dramatically change the business climate or even change the business climate, we need a few good inflation numbers in a row. Like we can't get like 2 good ones and a bad one. We got one yesterday. It was kind of a bad one. It was PPI. It's not the big one. The Fed would tell you it's their 3rd favorite behind PCE and CPI. We get CPI, the big one, on Tuesday morning. But any thoughts on the PPI number this week, CPI next week, or just the general climate right now?
So does this lead into the recession question, Rich? Because I'm fired up.
Airport parking lots are full. You know, we'll eventually go there. Yeah.
Half a wet Woody into my recession rant. So I was talking to some friends who went out to dinner last night in Chicago, fancy restaurant, packed, girl on the goat. Talked to a friend down in Baton Rouge, was out last night, packed at a restaurant. I was in a little town called Truckee, listening to some live music last night, packed. I just don't see the recession scenario, and the market keeps receiving this inflation data, quote unquote. And yeah, inflation is nothing to be trifled with, but we've been dealing with it for a while. And I was thinking about filling up your tank with gasoline. And, you know, if gasoline goes way up, the first time you fill up your tank with gas, excuse me, while my teeth are chattering here, you know, you bend the hose so you get every last drop of that gasoline because it's so expensive. Oh my gosh, you know, whatever. And then eventually you get used to it. And I'm not saying we have to get used to a 7 or 7.5% inflation rate. And sure enough, after the producer price index number came out this morning, all the pundits said, well, they started picking it apart and they're saying, well, this doesn't apply, that doesn't apply. It's not so bad, not so bad. But, and we don't have to necessarily live with a 7% inflation rate, but people are kind of getting used to it to some extent. It'll come back down. the Fed raising overnight Fed funds target rates have to have an impact at some point. The general consensus is they're going to do 0.5%, 50 basis points next week. Great. I think the market will be satisfied with that. And at some point it will have an impact. It's like, Rich, I know you can relate to this. So it's like eating edibles, right? Eating edibles, you have a little edible and nothing happens, have a little more edible, nothing happens, eat a little more edible.
We're talking fruit, right?
This happened to me the other night. Anyway, you get to the point where it's like, oh my gosh, I really feel this. Oh my gosh, I had too much. I had too many edibles. So the Fed doesn't want that to happen.
Well,
With their rate increases.
To me the other night.
What's
That
that?
explained your text messages to me the other night. Soft.
Anyway, forget that stuff, Rich. Don't mention it here on the show. Otherwise, we're going to lose MGIC. So what I'm saying is, yeah, inflation is a concern. It's almost built into the market at this point. The consumer price index number that comes out Tuesday will be much more relevant to the average person. And I hope it comes down, because at some point, like I said, the Federal Reserve's, the FOMC's actions will have an impact, and they are having an impact, I think. It's just, you're trying to turn an aircraft carrier here, and you don't want to overreact. You don't want to have too many edibles. You don't want to have too many rate increases. And I think the Federal Reserve realizes that, and they're shooting for a soft landing. But until then, the financial press has nothing better to talk about than rant about this, that, and the other thing. And I should add, I will finish up with this, and I can't see my screen so well because my vision is blurry because it's flipping cold here on assignment for TMC. Chris, we need to continue to look at what's the questions that are coming up and the chat topics. And I think they are coming up, but I can't quite see them because
it's all edible.
Yeah. Anyway. Oh, it's all edible related. That's great. Great. Anyway, Chris, are you seeing, among your clients, obviously the inflation is driving interest rates, and interest rates have gone up and so forth, but interest rates have come down, and now they're kind of waffling around a little bit. I have an off script conversation topic, Chris. Are you ready?
I'm ready.
So when you are in a private MI company looking at counterparty risk, looking at your clients, seeing how well they're doing or how well they're not doing and so forth, how much do you get involved in saying, hey, Rich and Rob's Mortgage, we think, we see this kind of trend with you. We're looking at your business that you're sending us and so forth. Let's take a look at your business. How involved does MGIC get involved in their counterparty's business?
Well, I can say, and this is, I'm sure our competitors do this. We do, monthly, quarterly, yearly reviews of business segmentation. So we're tracking, our individual larger lenders and even regional, local, strong clients. And we're looking at, the percentage of, high DTIs and of higher LTVs. To be honest, we've not seen a tremendous spike in risk parameters of loans. I think in large part because the agencies, AUS systems really kind of, have somewhat dictated that. And we are seeing an uptick from portfolio lenders in creative products, but not actually as much as we might have normally expected. So we're pretty comfortable with, the risk profile that we're seeing, and I would imagine so are, the other 5 MI companies.
And you offer contract underwriting, right? I mean, that gives companies the ability to scale up or scale down without hiring an underwriter.
We do, and we have done that for 25 years. At points like this, though, that volume definitely goes down because so many people are just their volume is so off that they're just trying to hang on to their own staff as opposed to outsourcing. But some people's models, it's just built in, and that works very well for them. And so we're still doing a good bit of it.
Weird component to the PPI number this morning that's really worth mentioning. It was up 0.3%, but vegetable costs were up 39% month over month, which led overall food costs to be up 3.3%, which exactly offset a 3.3% decline in energy prices. I'd been hearing this throughout the month that vegetable prices are going up, but that was the big culprit in the PPI number this morning. Rob, I know you just eat, peanut M&Ms and Doritos, but any thoughts on this vegetable breaking news?
So you're talking to the right guy here, Rich. So coming from an ag family in California, agriculture and crop prices are near and dear to my heart, especially living near Salinas, which is where a lot of lettuce, radishes, row crops come from. And you have a situation where there's a lot going on when you talk about crop prices like that, whether it's inability to get inexpensive labor from Mexico or the United States. You have fuel costs, getting, radishes and lettuce and other vegetables to other markets around the United States. There's a seasonal factor to that too, because, there's not a lot of vegetable growing going on in November and December and into the, January, February period of time. And the overall, though, I would expect that'll come down, but it does bring up a point, and Chris, we talked about this a week or two ago on the show. When you look at what families have to deal with, if the price of butter goes up too high, that you can substitute margin. They'll move to margin. So there are substitutes that families can do instead of going to Gino's East Pizza Parlor. You can get a frozen pizza for $5 or $10 at the supermarket. Vegetables, not so much, but you can move certainly from fresh vegetables to frozen vegetables, which freezing putting on my food science hat here a little bit, freezing tends to retain a lot of vitamins and minerals, much more so than canning. And so families will move to frozen vegetables, which are much more economical, and the fresh vegetables, too expensive. So there are changes in consumer behavior that take place when things go up in price. And I can see vegetables being one of those.
Interesting. Chris,
we went down the food science economic rabbit hole there, Rich. Thank you very much for that.
I think it all kind of plays into the whole edibles theme.
Yeah, there's a lot of grow your own comments in the chat, people noting vegetables, Rob, vegetables. Yeah. So, I
just lost feeling in my feet, but let's keep going with the show.
Onward and upward. So, Chris, some other stuff that's been in the news, conforming loan limit changes, these FICO inspired credit cost increases. Curious though, Chris, how the MI companies look at the conforming loan limit increases, because it impacts your guys' world, obviously, on loan amounts and coverage. And yeah, I would be curious to hear that.
Well, I think, it's hard to speak for the entire MI industry, but I think in general, we think they're positive. Obviously, the amount of MI that increases the number of conforming loans that are able to be done. And when you're talking about high LTV loans, the percentage of MI of agency loans is much higher than portfolio loans, because of many portfolio lenders deciding to self-insure, or whatever they want to call that, when they don't purchase MI. So it's a positive. And in general, we all align with I believe we've all pretty much aligned with the AUS findings. But it is interesting. We're also sliding up some of our non-agency loan amounts for those portfolio lenders as well. So it's a little bit of a retooling motion here.
Rob, any other chatter in your email inbox, either on this issue or maybe more notably the credit cost increases?
Yeah, credit card debt is through the roof this year. I think it's the highest it's been in decades, and that is an issue that people will write to me and say, what's going on with credit card debt? And when you talk about I'm sorry, I did glance at a chat comment there from some someone new to the industry. So,
I love when you drink.
you know, when you talk about some of the consumer spending and so forth that's going on there, yeah, I think that there is a concern that at some point the savings that consumers built up over the last few years of COVID, because they weren't going to Disney World, they weren't going to Disneyland, they weren't eating at places like Garwood's here in Lake Tahoe. They will burn through some of that savings, and the household balance sheet will be impacted, and that wages are not quite keeping up with the inflation rate, and so the consumer will suffer. Yeah, I think there's some credence to that, but I think we've got a long ways to go for that. And when you think about credit card debt, yeah, credit card debt is running up, but remember all the millions of people that this industry refinanced into 2 3/4 or 3% loans, and how much they're saving every month versus whatever, 5, 6, 7, 8% loan they had. And so it's a very interesting dynamic, behavioral economic dynamic about people running up credit card debt and not paying it off. Certainly interest rates have gone up, and I think that we will see that over time. But right now, once again, putting on my anti-recession hat, the job market is very strong. We're dealing with inflation, but housing is weak in some, really high priced areas. But for the most part, middle America is not seeing, these sensationalist headlines. We've talked about this before, Chris, so sorry about this, but I'm going to repeat. You see these sensationalist headlines about housing plunging, this plunging, that plunging, housing crisis, yada, yada, yada. We've gone up 20% a year for the last couple of years. At some point, it needs to slow down to have a healthy housing market. And tomorrow's commentary has a letter from a real estate agent about how we're returning to a normal market, and that's a good thing. So I would expect that, yeah, consumer credit card debt is up, but I think they'll pay it off. I don't know. I just don't see a catastrophe ahead of us in terms of recession or a depression or whatever. I just don't quite see that. And I think we're getting a lot of comments, but I can't quite read. Chris, what are you seeing? Are you seeing that the loans that your clients are originating, are they, quote, do they have more hair on them than in the past, or are they pretty just kind of cookie cutter deals that are coming across your desk?
From a national underwriting, position, I've not heard a lot, and I'm on a weekly call with all of their senior sales management. We discuss issues like this. Quality is challenged a little bit, but it's not, we're not facing that typical, let's pull out every loan that's been in the back of the drawer. And I think in part just because the violent swing of upward rates. So it was almost like, there's all those loans that were in the drawer, they're just not even remotely. So, it was almost just this full restart of got to begin a brand new pipeline. And, I think the interesting part of that is, we talk a lot about affordability and that first-time home buyers are shocked by interest rates. And the longer we get past this significant increase in rates, the more normalized these rates are. And someone pointed out in the chat that, yeah, they can't find homes to buy. And that is going to be a persistent problem, but that's going to retain, some of the valuation of homes. You still have this huge millennial surge that's pushing through the system. So yeah, I don't see a huge pull. I mean, we don't see a huge pullback in pricing, in home values nationwide. And, we think the underwriting quality is still really, really strong.
Yeah, I think, perfect. That's a great point you make, because it echoes exactly what I said. It's in terms of gasoline, gasoline prices shoot up and you're trying to get every last drop out of that gas nozzle. And then at some point you just kind of get used to it. Yeah. Housing prices, kind of the same thing. Interest rates, kind of the same thing. Humans are very, over time, adaptable to, I remember going down, once again, the food science path. I grew up working in a cannery, and the noise is deafening when the first day on the job, the cannery noise, all the cans and everything, just the machinery, it's deafening. You put in earplugs and so forth. By a week or two, you just get used to it. And I think humans are very adaptable at getting used to certain things. And yeah, interest rates, you talk to a lot of veterans in the industry who's like, oh yeah, I started, interest rates were, 18% or 16% or whatever they were, and people were still buying houses. And the current batch of home buyers isn't necessarily used to these rates where they are now, but people will settle in and 2023, I think people will be okay. Are you seeing, Chris, among your clients, everybody's cutting costs, trying to stay ahead of volume and margin and so forth? Do companies ever come to, say, MGIC and you and say, what are companies, how are they cutting costs? Sure, you can cut personnel, and vendors and lenders are all cutting salaries and furloughing people, but are there things that you're seeing among your clients that might be a good 2 or 3 things that you've seen in terms of cutting costs and helping the bottom line?
I wouldn't say that we get deeply involved in that. I mean, of course, people are taking this time to examine their tech stack, and we do help along those lines a little bit. We certainly, when lenders are having to lay off people, we often get involved in helping, the people that they have to lay off, find new jobs. But that's about the size of it in terms of cutting costs. I will note, completely change the subject here, if that's okay. I will note that it's kind of interesting to see the ARM production and buy downs, continue to spike upward. And I honestly think that's going to be a trend. I don't know so much the buy downs, but certainly the ARM product is going to be a trend that's going to continue. And that then lends itself to the financial institutions who are able to price arms with a different methodology than Wall Street.
Yeah. Are you, ARM, the intermediate ARM market did very, very well early in the year when interest rates first started going up and the yield curve got very steep, and intermediate ARM looked, 3.15, 1.7 looked great relative to 30-year fixed. And of course, the banks and the credit unions, cleaned up on that. And then as short-term rates continue to go up through the year, that intermediate ARM market kind of fell off a little bit. Is that something MGIC tracks? And is it do you think it's an indicator of anything in particular, or is it just kind of is what it is, and the ARM volume goes up and down and always, but probably always is less than 10% of the overall market?
I can't share any exact percentages, but we've seen a steady increase, and it continues to increase. So yeah, where maybe some of that really crazy pricing that, a credit union or community bank probably just didn't even notice, hard to believe, but, had left out there. We still see them, although liquidity is becoming an issue, we still see them, pretty aggressively wanting to produce arms and book arms. It reduces the duration of their overall portfolio, which is really important for them, considering a lot of them booked 30-year fixed rates. So we see that market is really active. And the TPO market from community banks and credit unions, a lot of them are examining or standing up small TPO operations. So those are some of the undercurrents I'm seeing in the industry right now.
This is the Rundown with Rob and Rich. Rich Torbinsky with the Mortgage Collaborative. Special 12 days of TMC edition. We're wrapping up week 2 of the 12 days of TMC with this episode. Week 3, you'd think we're slowing down. We have a huge week next week. Keynotes are Doug Duncan from Fannie Mae, Chris Herbert from Harvard Joint Center, Steve Richmond, who's always very entertaining, and Renee Rodriguez. We've got sessions on affordable loan products, buy downs, renovation lending, cost cutting, a lot of the stuff we're talking about here, individual sessions allocated to them. And then, of course, special editions of this show in the last week of Mortgage Today. So don't forget about week 3 of the 12 days of TMC next week. A lot of stuff coming
Special edition of this show?
Special, yeah. You
Is
weren't
that
prepped?
next week? I think this is pretty special with Chris, Rich. I mean, what are you already throwing Chris under the
Oh,
bus?
this is also a special edition. Yeah, we do special editions every week of the 12.
Every
How
week.
does one get, how does one get invited to like the 12 days of I don't remember seeing one thing in my email about, hey, join us for like listen in or go to this session or that session.
Really?
How do people learn about the sessions that are being offered through TMC?
I think most of our members would say, "Oh my God, we know about it. You've emailed us 800 times by like November 10." But it's our member engagement team really is the one that's interacting with our members and letting them know about stuff like this and the way they prefer to be communicated with. So that's, I think, one thing we try to do is meet people where they are in terms of communication and email and all that. So
So Chris, I'll tell you about Lenders One after the show, but the numbness is creeping up my legs here. I won't tell you what stage where the numbness has reached, but it is flipping cold out here. The thing that I grew up, not grew up, I should say, the private mortgage industry has always been such a valuable partner with the lending industry, Chris. And anytime that I needed help with something, the MGIC and you have competitors. I know that's late breaking news to you, but yeah, there are other competitors, but they were always willing to help. And besides the contract underwriting that you offer, what do you think are the most popular or the most underutilized products that MGIC can offer either for free or very economically to your lender partners?
Rob, I would say I'd start by saying, it's really impossible for me to answer that question because we have so many offerings, services, products, relationships. So, we really start by, all right, who am I talking with? An independent mortgage banker, you're a large bank, are you a regional office, financial institution, and then really examining it's a needs-based conversation, examining what are their pain points. But we offer phenomenal training from both a sales perspective and the operations perspective, customized in training, home buyer education and home buyer training, a lot of those things that a lot of marketing pieces for loan officers that loan officers are looking for ideas on how they can get out and market various products, and we have people that specialize in various areas like myself that specialize in working with financial institutions on portfolio products and things of that nature. But the list is long, and we just look to engage with people and hear about what they're really focused on.
And how much do you interact? Oh, go ahead, Rich. I'm sorry.
Just saying some nice comments in the chat about MGIC's training, which is free, and we've also dropped a link in there. So please utilize that. It is we constantly hear that you guys do such a great job with the training that you're putting out there. A lot of lenders use it to supplement things they're doing. And again, the link is in the chat for anybody that wants to check it out. But I'm sorry, Rob.
Yeah.
Lost your thought. You had something good there, and it just was, it was woodied away. So there's some good stuff in the chat. Hearing chatter of some lenders having issues with Fannie and possible suspensions due to company financials being reviewed can only get worse for fourth quarter. No, we have been hearing some of that, just that the GSEs are a little bit more scrutiny on their annual renewals they're doing of lenders. We want to be a resource there for our members. So if you're having issues there, or you need some additional clarity on that, reach out to myself or somebody on our member engagement team, and we can look into that. Rob, Chris, anything you've heard along those lines?
I didn't hear that last part, Rich. What was that?
Just Fannie Mae reapprovals, a little bit more.
Yeah, I've heard, there's talk. I wrote about it in my opening paragraph today, the fallout, putting on taking my food science hat off and putting on my capital markets hat, the fallout has really increased because lenders are trying to get deals in the door, and they will start processing the loan, lock the loan, and then it'll fall out of contract, and they incur these expenses like credit reporting expenses and other expenses. And the fallout has really increased. And on the back end, I hear these stories about, Fannie Mae and Freddie Mac. Their buybacks have increased. They are, putting products back, and sometimes lenders are being asked to buy back loans or take back loans that are, a 3% 30-year fixed, or a 3.25 30-year fixed, and they're, that's a big hit to anyone. But if you're a thinly capitalized independent mortgage bank, it's an especially big hit when you're dealing with a scratched and dented product, $300,000 loan, and you're selling it at 70 cents on the dollar. Chris, what are you hearing? Have you heard any statistics or seen any statistics about agency buybacks, and have they really increased? And what is the reasoning if they have?
We don't really, I've heard of a number of people anecdotally, just as you said, the pain is great, right? The fees when you make a mistake and are handed back a loan, you're, as you said, 70 cents on the dollar. And if you talk about large loan amounts, that can be extremely painful. But that's not an area we really delve into too much, unless, occasionally MI can cure things, on a loan where maybe there's a valuation issue or something like that. But I certainly have heard where a number of institutions that are applying to become Freddie and Fannie seller servicers, that bar is definitely raised a good bit higher than it had been traditionally. And, and warehouse lines are really tightening up. So, as one would expect, when it's hard to actually make an average profit on most of the loans that people are closing, there's just a lot more scrutiny on the stability of companies.
Another interesting note in the chat from Dottie: one piece of good interest rate news for the lenders who can handle the operational requirements is that HFAs are pivoting from TBA to tax-exempt bonds. The tax-exempt bonds will produce a below-market 30-year fixed rate. Check in with the HFAs. So you may not be able to make money on the bond loans, but the rates seems like they'll be more competitive. So Dottie, thank you for sharing that good news. That has been one of my pet peeves for years. I don't know why lenders are not allowed to make money on the bond loans. You put the product out there, and there is now people will do any product because they're starving for business, but you're in a more normal climate, and loans go away from those products, or they don't get done because people don't want to deal with it. And I don't understand that. Like, let lenders make money on these products. It makes no sense to me. But what else in the chat? Let's see here. I heard say something about scratch and dent product. How does a mortgage become a scratch and dent?
If I could put in a shameless plug for adding work onto my shoulders, and that's not even a shameless plug. If somebody out there needs a scratch and dented buyer, I keep a kind of a informal list of people that they can, or companies that they can reach out to. So, shoot me an email if you've got my email, or reply to my commentary. And, if you need help in that area, it's there are, and Chris, I know this isn't really MI related, and I know we need to talk about more about that, but the scratch and dent business is actually can be a very lucrative business, because, you could have companies out there buying perfectly good loans with borrowers making their payments at 70 cents on the dollar. And then when that person refinances or sells their home and moves to a bigger home or whatever happens, you're getting par. You're getting, you buy something at 70 and buy, in effect, get par back. I mean, that's a great business model. And so there are companies out there that do very well buying scratch and dent loans and then refinancing them, or having a lender refinance them and get back, the full value. It's a good way to make money. But it takes some patience and it takes some skill. So anyway, my 2 cents on the scratch and dent. But so if anybody needs a buyer out there, shoot me an email.
So what makes a scratch and dent loan a loan that has been manufactured wrong, so it's now unsaleable? Something in the manufacturing process that makes it unsaleable before you sell it. That's probably the most common scenario. And then like loans that lenders have to buy back due to after the fact reviews and things like that. So you're sitting on a loan that does not meet regular agency guidelines. You got to find somebody to buy it. That's the term scratch and dent. Typically buyers are paying between 60, 70 cents on the dollar and 99, 100 in some cases. And yes, a lot of very smart people have made a lot of money in that area of our business over the years. So Chris, any thoughts on the scratch and dent side of our market?
Yeah, just as I said before, I've had a number of circumstances where people have looked for referrals like that, and I just had one with a great client that was a very large jumbo loan, and closed with outsending a kind of a tweener appraisal to the investor, and it was a painful experience for the lender, even being asked to buy a higher level of MI coverage on it to purchase it, but saved them, I think it was like $300,000 in terms of, what the scratch and dent. So, yeah, I think it just goes to, we're all, in the mode of trying to close every loan, but it's just super important to stay, focused on execution, so that, those loans that you're closing aren't, going to end up in that bin.
And we got a couple good partners at TMC that are linked in the chat that buy the scratch and dent loans as well. So Chris, one last question. I know Rob's got his hand up. The wet woody is wreaking havoc on the coast of Lake Tahoe. But strips of MI on portfolio loans. I remember in my bank days working for banks that were really, really risk averse, maybe it was like a 95% doctor loan that we did without MI, or loans that maybe we did it, 85% without MI in the portfolio, worried about home depreciation, buying like a strip of MI for a pool of loans in the portfolio. It's only a matter of time before that starts happening. I think, again, has MGIC seen any of that?
Yeah, absolutely. And most of that's with portfolio lenders, where they may have originated a group of loans above 80 LTV without mortgage insurance. And there's a number of reasons why they may suddenly want to, purchase mortgage insurance. It could be a capital thing, could be a liquidity thing, it could be a saleability thing. But yeah, no, it has been not tremendously active, but a part of the marketplace, and we see it continuing to ramp up, especially as, let's just face it, a lot of these institutions that have portfolios with low interest rates and long durations, eventually they're going to have to move some of those loans. And, if a large portion of them are above 80 and don't have MI, they're probably going to pick up, maybe a percent or two better in the pricing by, buying mortgage insurance on it. So we'll see that as I think is something that, this market matures, that we get more and more requests for.
One more note from Dottie real quick on the HFA issue. Note, thanks to David Batney as head of the MBA's Affordable Committee, HFAs are starting to hear lenders loud and clear about the margins on their loans. If you haven't checked in with them for a few years, try again. Great advice, Dottie. And I've heard that about David with MBA and the work he is doing on behalf of affordable lending, working with the HFAs. So shout out to David Batney at MBA for the work that he is doing. That's the type of stuff MBA is doing behind the scenes. And, you could love MBA, you could hate MBA. We need the MBA because DC hates the mortgage industry, and anybody that is not supporting MBA in this industry is crazy. Rob, you had your hand up. Did you already forget
I was, Tom Gallucci, who I think is still on your staff, barely, was making mean comments about me, about my ability to come up with a scratch and end buyer, which I can do just fine. So anyway, it's did I mention it's flipping cold out here?
You look cold. Yeah, you look cold. So
Should I show you one more time where I am, Rich? Just to so the it's it's cold.
looks cold. There's somebody running down there.
So are you there to ski or just imbibe?
I'm on assignment. You know, Maurice Flabber sends me where they want me to go. It's like 1 week it's Mexico, the next week it's Lake Tahoe, next week it'll be Chicago. After that, it'll be Rich. Are we even doing a show on December 23rd?
I forget. I'll have
Never
to,
mind. Sorry, didn't mean to stump the chump here. Sorry.
I think we are going to do just like a short, fun, you know, yeah. So for the 50th
right.
show, but
Anyway,
so
no, I think to before my jaw freezes up here and I can't speak any longer, I will say this about MGIC. To Chris's point, the products that you offer at very reasonable or free for your clients, it's amazing. It's something that lenders need to take advantage of, and I don't think enough of them do often enough. So keep up the good work.
Thank you. I appreciate that.
And Chris, anything else from your perspective, just working with credit unions across America? Feels like a good climate for the depositories right now, credit unions within that. Obviously, it's, you know, you've got very diverse types of credit union mortgage lenders in America, some that are, you know, more traditional, smaller credit unions, some that operate like full-blown IMBs. You know, they definitely have some business advantages. And yeah, we'd just be interested to take us into the weekend. Any just broad perspective you're seeing on that segment of our industry and all the work you do with them throughout the year?
Yeah, no, I think that, you know, they will, as you mentioned, there are some with fantastic origination sales forces, but in large part, they haven't and probably won't build the sales forces that independent mortgage bankers do. And, you know, there's a lot of reasons for that. So, you know, they will be able to take advantage of their portfolio capabilities, but not entirely. And the whole TPO opportunity with them, you know, if you put the work in, it's hard to connect with the senior people at a community bank or a credit union, but if you put the work in, there's opportunities there. So you know, that might be something to explore.
Love it. And the chat
Hey,
was
Chris, did you tune in last week by chance?
I did not.
Okay, so have you ever heard the term mollywomped?
No, I have not. Is that what happens in Lake Tahoe if you have too many woodies?
Well, that
don't fall
after
in the
hours.
lake. Don't fall in the lake. Yeah, you know, it would be good for ratings, but
the lake is warmer than where I am now. But Rich, do you want to explain the term mollywomp, since I think you were the one who used it?
I don't even know where it came from. I was, you know, describing what Chris Bennett's Michigan Wolverines did to my Ohio State Buckeyes, and I felt like I needed more than a normal adjective, and it just, yeah, it came out of nowhere. I don't know if it's a real word or what it means, but a lot of people are using it to describe Rob's sobriety condition on the show this week.
So Chris, as a quick aside, sometimes people are staring at me through the windows. Every once in a while, somebody will write to me and say, Rob, at the next conference, I'll buy you a drink if you work this word or this phrase into your commentary. And I think I need to work mollywomp in there in the opening paragraph on Monday.
All right,
that'll be my goal.
I'll look forward to it.
Love it. Chris, any weekend plans in the DC, Northern Virginia area?
Getting ready for Christmas.
Getting ready for Christmas.
Yeah, got to do some of that shopping. I think I got to put up some lawn ornaments, so it'll be a fun weekend.
Rob, weekend plans at you in Lake Tahoe all weekend, or
hanging out with a friend or two and trying to stay warm and just Not much of anything.
Living the
Hopefully,
dream.
hopefully it wasn't the person heckling you in the chat, which the chat was great, by the way, today. And keep up the funny stuff. I didn't do the chat justice because it was just a stream of just funny one-liners throughout the show. So again, if you listen to the podcast only, which there are thousands of you that never even come on the live and just listen to come on the live broadcast, it's usually several hundred people and a lot of fun. And you get to see where Rob is showing up live from and what he's drinking. So.
Yeah.
Chris, thank you very much for joining us this week and for your role, a vital role in the partnership between MGIC and TMC and you know all the things that we've worked on together over the years. Really appreciate you just as managing this partnership and obviously the long-standing partnership with MGIC. And thanks for being with us today.
Absolutely. Thank you.
Thank you very much.
Enjoyed it a lot. It was a lot of fun.
Absolutely. And to our listeners and viewers, until next Friday, thanks for wrapping up the week with us. We'll be back next Friday, special edition. Once again, finalizing the 12 days of TMC. Next week's edition, the show before it is Katie Klaus and I of People's Mortgage, who is funny and hysterical. We're going to do a mortgage industry year in review, which we're going to just make it funny and, you know, and just the only way you can really wrap up a year like this. So that will be next week before that. But until next Friday, have a great weekend, everyone. Take care. Bye, Rob.
See
Bye,
y'all.
Chris.
Bye.